Hey everyone, welcome back. We're digging into Volex at the moment, which is a company that make cables. In the previous video, I explained why it's not as silly and boring as it sounds. There's a really interesting turnaround story, and I think it's important to figure out the turnaround story because that's quite a big thesis for this potential investment. Today, we're going to look at some of the metrics, and we're going to look at the growth opportunity, do a competitive analysis, look at some of the risks and things like that, working towards evaluation. So let's jump in. We're going to look at revenue growth first. So this revenue and operating margins graph that I have here on the screen, it tells the story of the turnaround, which was happening in 16, 17, 18, and operating margins are getting close to 7, 8%. They're actually getting, the aim is to get them to 9 or 10%, which they're well on their way to. Revenue has really bottomed out in 2017-18 and has started to rise back up. They're well over 600 million euros now. They're pushing 700 million at the moment. And yeah, the past 5 years has been a very good period, and the turnaround has been shown to work, which is really cool. So now we're looking at return on equity, return on capital, return on assets, the return metrics of the business essentially. So based on TIKR's numbers, we've gone from negative from 2014 to 2018, we're looking at negative returns to finally pushing up close to 20% for a lot of these, which is really great to see. Again, the turnaround has worked and looks like it's going to continue working because they've built this competitive advantage. So this is slide 7 of the first half financial year 2023, and they're saying that the return on investments now hit 22%, and the return on capital employed at about 20%. These numbers are really strong. It shows that their acquisitions they're making are generating excellent returns. And not only the acquisitions are getting good returns, the investments that they're making internally as well have strong return numbers too. So everything's looking really good here from Volex, and it's a big difference to where they were 5 years ago. Now looking at the debt, back in 2014, debt was even higher than equity. It was a terrible situation the business was in. They were way more leveraged than they needed to be. And the turnaround has taken the debt essentially out of the picture, and the business has grown substantially over that time as well. So debt looks good. Now regarding free cash flow, it's actually all over the place because of there's been increases and changes in inventory levels recently. I'm going to explain why that is possibly good and possibly bad, and that's for a little bit later. Regarding shares outstanding, there is stock-based compensation of about 3% per annum. This is a bit higher than I would like. I prefer it to be 0 personally, and we need to look at the per share numbers when we're like earnings per share, free cash flow per share, things like that, because we don't want to be misled by the dilution of the stock. Now regarding the dividend, there is a small little dividend. It is under a 20% payout ratio, so I think that's okay. Regarding incentives, well, Nat, the CEO, he owns 25% of the business. He can make about 3 million in a good year as part of his salary, bonus, and stock-based comp, but compared to his $75 million stake in the business, that's a pretty big difference. But that stock-based comp is still quite sizable. So regarding growth, the electrical vehicle segment is the one that has the most growth. It grew 53% year on year just recently. And that is something that, well, unless you think electric vehicles are going to slow down and not be a big part of our world, this looks set to continue to grow, I would say. The consumer electricals business, which is the legacy kind of business, they've tried to specialize in this, niche down as best they can. That's growing we grew at 8%, but let's say it's even just flat because of inflation and things like that. Medical revenue is the same. It's about 8% growth. And again, with inflation in the UK being 10% and around the world being in the high single digits, this is essentially flat. And then the complex industrial technology, this is like bespoke niche products that they're making. That's up 44%. And I really think this is a great area for them to grow further in as well. So now this slide here on the screen is showing that the 5-year expected market growth for each of the 4 sectors that they operate in, and then the growth that they just experienced. So electric vehicles, that growth is expecting at 19%. I think that's probably fair, but they're growing a lot faster than that at the moment, which is cool to see. And their 5-year plan for by the end of 2027, they want to hit this 1.2 billion in revenue number, have their margins at that 9-10% range, but not higher. And that's important, not higher, because they want to have this scaled economy shared idea. And the revenue from acquisitions, they want to keep being an acquirer and have revenue coming in at least 200 million of that 1.2 billion. So considering revenue at the moment is almost 700 million, they're well on track, I think, to hit this 1.2 billion revenue number in 2027. Their margins are on their way to 9 or 10%, and they're looking at more acquisitions, and they're producing plenty of cash. So I think this is a pretty conservative 5-year plan. I think there's a good chance that they beat this before the 5 years is up. But it's good to see that they've got some plans in place. And regarding that EV business alone, it was started from nothing, and now if it was spun out, it's probably worth $500 million easily as a business on its own. And I'll get to the valuation later, but the company is worth about 500 million. So I think the EV business is just 500 million. But anyway, we'll get to more on that later. All right, it's important that we look at the competition, and this is still a bit of a hurdle for me. It is a manufacturer competing in a competitive space, and competitors have started to shift into the same niche product ideas. The companies that I'm thinking about in particular are TT Electronics and Leone. They're the big competitors here in this space. TT Electronics in particular looks very corporate and bloated to me. The financials aren't even close to as good as Volex. Leone is a far bigger business, and mostly it's in the auto space. They're unprofitable at the moment, but attempting their own turnaround. So look, competition I don't think is actually very strong. They're not as good as Volex at all, but they're also not stupid. They're also big businesses, and they have seen what Volex has been able to do. So this is far from a monopoly, and I have to get my head around that. I think the multiples will never be like tech multiples or any business that has some sort of serious monopoly going on. I don't think we're going to see multiples any much higher than 15 times, and I think that's okay. Okay, now let me talk about a possible, not a red flag, let's call it a yellow flag. So inventory has gone up from 76 million to 114 million in the last sort of 6 to 12 months. And this has made the free cash flow look really weak recently because they've been building up this inventory. Now, if they can sell this down without replacing all of it, which they've got a lot more than they need, well, free cash flow will look really impressive, and it'll look more impressive than it should in 2023. So be really careful on that if you see this big free cash flow number come in. Now, if demand isn't strong and demand falls away, this inventory actually might sit there and it might age, and some of it actually might be hard to sell. Maybe some of it has to get written off or discounted badly to clear out, and that'll lead to like really bad margins. If you want to find out a bit more, page 115 of the 2022 annual report is where I went to find that information. Now, back in the 2018 annual report, I actually found a little hidden gem that I think not many people would think about when they look at this investment. That Volex moved from the UK main market down a level to the AIM market. Now, you might be thinking, why would they do that? And Nat said it was only to save money. They didn't care that they were on the top flight market of the UK. They just wanted to save money. They needed to be listed, so people could trade shares, so they could still be a public company. But they decided to just save money any way they could, and that means that the fees for the London Stock Exchange were higher than the AIM market. Okay, they took that all day. So I love this move. I think the ego got thrown out the window, and I think that's really cool to see. So I hope you're enjoying this look at Volex. In the next video, we're going to get into the valuation finally, and I'll summarize everything so far and whether we think this is something that we should actually be taking seriously and maybe investing in. So that's for tomorrow's video. Please leave comments below if you think this is interesting so far, and please pull this apart on me as well. I need the criticism to see what am I missing and why this is a bad investment. So let's jump into evaluation tomorrow, and I will see you then.